Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we dive in, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is a respected analyst and portfolio manager at Crescat Capital, whose research has been featured in Bloomberg, the Wall Street Journal, and CNN, among many others. Mr. Tavi Costa, welcome to the program.
Well, thanks for having me. Looking forward to this conversation.
Let's get started with your own journey in investing. How did you get started and discover investing, and how would you describe your overall investing philosophy?
Totally in accident, I would say. Started from a young age of living through ups and downs of my parents' businesses, where I think I've always seen money as a form of safety to my decisions in life, and therefore that dynamic kind of drove me to liking the strategy side of managing capital and understanding markets. I've always been fascinated by understanding businesses and what I consider successful business models. And therefore, once I met Kevin Smith, which had a much more of a quantitative approach to investing, I think that sort of changed my overall view about how to approach things. And so I started to really apply a lot of his principles in the macro side. I've been always very diverse as far as culturally and traveling and understanding the differences of each economies and how things are led by liquidity and markets in general may have maybe in a bull market in the US and maybe a bear market in Brazil and so forth. And I was always fascinated by that kind of set of opportunities worldwide. So global macro was always something that was in my mind. It was there's always an opportunity out there to be invested in. So I think over the years, I decided to start really working towards identifying big secular trends and build businesses that will be hopefully taking advantage and capitalizing from those trends that I think will be unfolding in the following 5 to 10 years. And so I think there's quite a lot of things to be discussing and quite a lot of things to be looking at and paying attention to. And therefore, I think that's sort of where I started with where I am right now.
Well, let's get your thoughts on what is unfolding right now, because I would like to dive specifically into commodities with you. But before we do that, I'd like to get your view on the market in general. A lot of people are talking recession. We're seeing bearish headlines every day. Where do things stand in your mind right now, and where do you see things, the challenges that are coming up for both the financial markets and the global economy?
Well, I'm certainly in the camp of a recession. I'm certainly in the camp of further reckoning of equity markets in the US. And I do think that you don't reach valuations that we've reached without having some sort of painful times ahead. And so I think certainly my views are that we're going to see major capital shifts in terms of trends out of equity markets and into tangible assets. This is highly linked to my views about inflation. I think lots of smart macro guys are considering the current scenario by looking back 10 to 20 to 15 years when they should really be looking at 50 years or so. But there isn't really an analog to look back and think about what's happening today. I mean, this is what I call a trifecta of macro imbalances. We have the problem of the 1940s, we have the inflation problem of the 70s, and the speculative environment of the 90s. And that constrains policymakers over time to really fight inflation. And so I think that when you have more and more units of debt in order to generate growth over time, at a time when also you have inflation creeping up, there's not much to do outside of loosening monetary conditions at some point at an already inflationary environment. And that's what creates a monetary crisis. In my view, you have to look back in history at inflationary times to see how other assets have performed during those periods. And certainly tangible assets, commodities to equity ratio at a 50-year low just beginning to rise, and you see all this macro guys and market participants claiming that the commodities market already went up too much. Well, relative to equity markets, we're just getting started. So I think there's a lot more to go in that ratio. And that is what I'm mostly focused on. How do I make money asymmetrically on the long side of a portfolio looking for tangible assets like commodity businesses on top of shorting what I think is one of the largest financial bubbles we've seen in history when you look at equity markets in the US. So I think there are opportunities in both sides, and there's no shortage of things to be busy.
Okay, well, let's touch on those opportunities because to me, it looks like the commodities space in particular presents a very attractive value proposition right now. We've got a lot of underinvestment that's been going on in the sector for a very long time, a lot of supply demand fundamentals that are very bullish. In your opinion, are we entering a large bull cycle for commodities? And could this be the biggest bull cycle we've ever seen in the commodity space?
I think so, but I don't have to be right about being the largest. I think I need to be right about direction, and it's been right so far. I think the capital constraints, regardless if it is caused by extreme conservatism of corporate behavior forced by shareholders, pressure on different forms of either through forcing them to look for opportunities that generate cash flow, but also cutting cost, or through the political environment of ESG policies that have been constraining companies in the natural resource space to produce, develop, and explore in their businesses. And so that's a big part of it. The CapEx trends that I think now every macro shop now have nowadays a new commodity CapEx cycle chart to share. But 2 to 3 years ago, there was not a lot of people that would really looking at those trends. And I think those trends take a real time or a long time to reverse. And so you have to watch that very closely, but we are nowhere close to times like we saw back in '08, which I've seen a lot of folks comparing this recent rise of commodities perhaps are analog to what we saw back in '08 before the global financial crisis. I think this is not '08. I think this is very different than '08. Back then, commodity producers were spending right and left when it comes to CapEx. And today, they're actually doing less CapEx than what they do regarding dividends and buybacks. And so they're being forced to attract shareholders at a time when cost of capital is rising and the Federal Reserve is being forced to tighten monetary conditions. What is that going to do? It's going to reduce the availability of credit, but also capital for those businesses to continue to perhaps form new projects that will be coming online and feed the world when it comes to natural resources. And so we have a lot of issues with that that will take a long time to fix. And so I've been very focused on different parts of the market. I think you have the metals. The metals are incredibly interesting. Precious metals as businesses, when it comes to producers, are one of the most profitable businesses. And this is just looking at margins in general. You look at the base metals, they're also very profitable. Second in that list, the oil companies are also extremely profitable, but they carry a lot of debt. And so you have to be careful with balance sheets, and you got to get it right on the timing. Otherwise, you may have issues with a downturn, but that's not my view. I think this is the time to be buying all sorts of commodities, from soft commodities to energy to base and precious metals. I have my favorites. I think silver is perhaps the cheapest metal on earth, and I've said it many times. And I think it's very difficult to find ways of exposing a fund or an investment portfolio towards that idea, because there's a lack of opportunities out there that are high quality and have the potential to be linked to the silver price. And so there's a lot of ways to do this, but I think this is probably a once in a lifetime opportunity where wealth is going to be created through tangible assets and not what we're seeing so far, which is in financial assets. Housing markets may actually outperform financial assets like we saw in the '70s. This was also a trend that we saw back then. It doesn't mean, I personally think financial assets in general at this valuations compared to commodity producers are in real trouble. It's all linked to cost of capital rising and making it more and more difficult to justify valuations of equity markets. But on top of it, coming back to the profitability times when investors start prioritizing companies that actually make money. And that is not the majority of companies in equity markets as far as the S&P 500 goes. It's hard to find a company today growing at a higher rate than inflation. And so I think it's becoming more and more challenging, and we're going to see a few lessons coming out of this. And one of them is going to be how inflation is not very kind to stocks overall.
So let's dive a little bit deeper into the energy space. You mentioned oil. How do you feel about coal, and how do you feel about uranium? And in the oil sector itself as well, some people are saying that all the big money has been made and there's not much room left to run, whereas other people are saying, peak oil is not going to come till 2030 or maybe even 2050. Is there still a big opportunity there, or is that ship kind of sailed?
Oh, I think there's a lot more to go. You look at the capex trends for energy companies are still basically at a 20-year low. I've never seen a market really peak at a capex trend at those levels. And so I think people are just too focused on the short term. Just because we've had a big move recently, it doesn't mean we cannot have a consistent market that can actually continue to perform well. Remember, software stocks and technology companies went up for many, many years. It wasn't a 1 or 2 year trend. It was a decade-long trend. I think we're on to something similar in commodities in general. Can I change my view about some commodities over time? Sure. If we do have capex trends at peak levels in an energy space, I will change my view. But we're so far away from that. And my understanding of those trends is that they take a very long time to shift. And I think this time is actually very, I hate to say, but it's very different than prior times, because we haven't seen really this same level of political pressure to not allow companies to spend capital in new projects and so forth. And so this is, in a way, this is sort of peculiar relative to other times in history. But I think this is all infiltrating an economy as far as inflation goes. And when you see other times like the 70s, energy commodities did very well. And so, and this was, again, a decade trend, not a 1 or 2 year trade. And so I love to, go back and forth with either, even internally at Crescat with the analysts that we work with, where sometimes we have our own views about trading short term, but that's not really where the real opportunity lies ahead. The real opportunity is to be able to spend time looking for the best ways to express this idea for the next 5 to 10 years, and not be rethinking too much about if things are a little overextended in the short term. If you are of that view, just be ready to deploy capital at any pullback. So that's really my opinion, is that we went from a market where buying the dip in equities was a great strategy that worked out very well. And I think we're going to see the same with commodities. Any pullback in commodities, in my opinion, should be bought. And so I've been doing a lot of that. Recently, we've had a lot of interesting consolidations. Look at the price of soybeans, look at the price of copper, look at the price of gold and silver. They've all been consolidating for some time. I don't know what the trigger is, but the macro thesis is certainly there. And at some point, I think we're going to see the continuation of those trends to the upside and not the downside. And so it will continue to feed into the inflation story, and will continue to constrain policymakers. And I don't know what the next CPI will look like and things like that, but I think there's a real trend for an investor that is looking to deploy capital in the space.
So let's talk a little bit more about the precious metals specifically. A lot of investors in the precious metal space are frustrated, especially the ones you find online, claiming that, it's not providing that hedge against inflation that it was promised to provide. How do you look at the precious metals, both gold and silver, moving ahead? And you mentioned silver was one of the most or the most undervalued metal at the moment right now. And do you think that's due to its role as a both a monetary and an industrial metal?
Well, yes, the answer is what I like about silver is how it is involved with so many aspects of the economy, from being a monetary asset to being historically undervalued relative to many parts of the market, from equity markets to the monetary base to money supply to other commodities. You've got the green revolution where it fits perfectly there, and also an asset that supposedly does very well during inflationary periods. I think people are looking at a little bit too early to make an assumption that silver is not going to work over the next 5 to 10 years if we're entering an inflationary environment. The first part of this, we've seen so far the Federal Reserve having to reverse its policy and have one of its tightest monetary policies reversals we've seen in history. And perhaps all the way back to the 70s was the last time we've seen this level of commitment on raising rates and also tightening conditions in general. And so I think that in face of that, and I'm looking at rate of change things, not so much the absolute terms of interest rates right now. I'm actually surprised gold and silver have been holding up so well. I do think that, as I said earlier, policymakers are constrained on how much they can do. And at some point we're going to see the reversal of that. And Japan is a great case for what's happening and may happen with other economies at some point. It's a place that is facing a true monetary crisis right now. They have a balance sheet size that is 100% or 120% of its GDP when it comes to the BOJ balance sheet. The Fed is only about 35% of its GDP today. And so I think we're going to get there as we start to see interest rates rise in the US, especially on the long end, that's being caused by other problems that have nothing, they're very uncontrollable parts of demand issues, supply problems in terms of issuance of treasuries. And at some point, I think we're going to see some sort of attempt to cap yields in the long end. But when that comes, I think we're going to see a big shift towards things like gold and silver. And the market's going to sniff that out way before most people. And so I think it's going to be, what makes that trigger and where we're going to see gold and silver prices go parabolic from here. And this is, as an investor, the only task that I should really be focused on is looking for the best opportunities in that space, where I find most of them is certainly an exploration phase, which is on itself is just a very interesting macro thesis as well.
I want to talk a little bit about the trend of deglobalization and the impact that that might have on the commodities market. When you look at just China alone, rare earths, graphite, there's a lot of critical minerals that come out of that country that, we might not be able to rely on anymore. And then you have the conflict in Ukraine affecting the agriculture market and some other things. How do these sort of geopolitical events and the current trend of deglobalization, how is that going to impact the commodities markets in your view?
I call this the four pillars of inflation, where we have wages and salaries growth, the similar spiral that we saw back in the 70s. We have the natural resource constraints when it comes to supply. And then we have the fiscal spending, which is also similar to other times like the 40s that also cause inflationary problems. And the fourth is deglobalization. I am not sure which one is the most powerful, but perhaps deglobalization is one that really calls my attention. There are a lot of things that will be I think, unleashed by those trends. One of them is going to be defense spending. We haven't seen much of that just yet. The other thing is going to be the reshaping of logistics and manufacturing globally, where we've seen countries like China performing very well as far as an economy growing and being the engine of the global economy over the last decade, may actually face a lot of problems. And that is precisely probably why we're seeing equity markets in China underperform equity markets in the US by a very large percentage. And so I think we're going to see a shift of balance of powers when it comes to the global economy. And that shift will be caused by countries that will be able to, just like companies, that will be able to benefit from this inflationary environment. So I'm worried about Japan. I'm worried about Europe. I'm worried about China. But I also think there are places like Brazil that may benefit from this. Australia may benefit from this. Canada may benefit from that too. Some other parts of South America may actually do okay. It is interesting how commodities are becoming more of an strategic macro asset to own, and actually to be able to have, as far as in abundance of some economies that are capable of having that, luckily. And so just by the degree of their natural resources that they come with. And so I think it's a very important trend that is very difficult to reverse. The same way wages and salaries is difficult to reverse. Once you have that on the rise and you have unionization and cost of living on the rise, it's difficult to say, look, we're not going to be paying you more. We're actually going to do the opposite. We're going to have to cut your salaries because we're just not doing well. No, that's not what's going to happen. In the 70s, what happened was that margins of companies got squeezed by that. And so those changes in logistics and manufacturing and so forth that we're going to see globally through this issue of geopolitical tensions that are rising are also exacerbated by debt. We have too much debt in the world. And so this extreme levels of indebtedness on top of low growth environment tends to create issues. And so we're going to see problems. We're going to see political shifts. And that's what inflation causes. I mean, the majority of big changes politically that we've seen throughout the world were actually caused by inflation. Inflation causes a cost of living to rise, and you see social unrest, and social unrest questions the current political party that is in place. And that's when you see those force changes. And so I'm quite worried we're going to see that globally. And I think Russia and Ukraine is just the beginning, not the end, meaning not that we may see a World War III type of environment. We may, but I do think this is going to be infiltrating to other sides of the global economy. It may cause issues with China. Let's say Apple, one of the business models that benefited the most when it comes to globalized world, right? I mean, the labor cost is low. They've got all their products are being basically built in a place like China. They've got the advantage of FX changes and the stability of the USD CNH over time. I mean, there's so many things that you can think about on a business like Apple that has really benefited from this global stage that we've had in the last 10 years. How will Apple perform if we have a shift where they actually have to bring back manufacturing to the US? This is going to happen, with a lot of companies, not just Apple. I'm not picking just in one. And so I think you need to consider, which companies are going to be in that challenging scenario as we think we see things shift. And I believe that commodity markets, they will continue to benefit from those, because those changes in relationships only reinforce that trend.
So for your average person out there who's interested in the commodities market, they see the opportunity there. Obviously we don't give investing advice here, but what would you recommend the average person do? Would it be ETFs? Would it be a fund that holds a basket of commodities? Obviously, looking into individual stocks requires a ton of due diligence and knowledge. So what would you recommend for someone like that?
Well, I think you have to be careful, first of all, with 401k plans that you see out there that are mostly invested in growth stocks and long duration assets that are going to get caught up over time on this shift of capital allocation out of things like treasuries and fixed income, especially corporate bonds and junk bonds that supposedly are part of that 60-40 portfolio allocation that has been so popular over time. And the folks that did use those allocations did very well in the last 20 years or so, but understanding that when you reach those structural changes in the economy, you have to be aware that correlations will change. And what used to be perceived as a safe haven and actually were acted as safe havens may not react to the same manner in the following 5 to 10 years. I'm referring to treasuries. I'm referring to even gold may actually replace some of that as well. I think that the best way for investors nowadays to be invested is looking at a basket of commodities. And I'm not sure there are many ways to look for asymmetry inside of the commodities market, but it's a very complex subject because it requires the more you dig into the space, the more it requires technical knowledge. And guess what? It's not just a capital trend. We have a labor problem where there's not enough folks that can actually navigate the space very well, meaning have the sufficient knowledge to discern what are good or bad investments in this part of the market. And so I think that the best way to do is take an approach of a very diversified portfolio of different commodities, from metals to energy. Some folks may do uranium. Some folks may also play coal. Some folks may look into soft commodities like agricultural commodities. That is certainly what we've been doing. I think coal is actually the only thing we're not invested. Just we haven't spent enough time to be comfortable with deploying capital in this space. You asked about uranium. I think you're always looking for supply and demand cases separately. And interestingly, I don't see much of the supply case for uranium. I think we have enough supply of uranium in the world today, and that's for more analysis. It's not the same case that you can make for copper or for silver if we're due to a green revolution. And so it concerns me those differences of supply case for those. But there's certainly a demand case for uranium. There's certainly a political case for uranium. There's certainly another perhaps possibility of where being maybe the cleanest form of energy that we may pursue here in the following years may create larger demand for that part of the market that could be very optimistic for that industry. So you just have to understand that perhaps some parts of the commodity market have a better case and some others have not so much of a good case. And so that's not the case with uranium. We're owners of uranium companies too, just not to the same degree that we've been chasing metals, because we know that the CapEx trends take a real long time to change. We know that we're probably going to be using those metals over time, meaning it's not like oil where we may be transitioning away from them. And so allows us to actually dig a little deeper and get into a more illiquid part of the market. Now, energy is not so much in that space. I mean, our energy positions are mostly in larger companies where we have higher liquidity, and we can trade in and out of those if we have changed our views. And so I guess it all depends, but I think a diversified approach of tangible assets will probably get you a better portfolio positioning than the traditional 60-40 portfolio that has worked in the last 20 years or so.
Well, Tavi, this has been an amazing conversation. Thank you so much for joining us. For people who want to find out more about you and your work online, where can they go?
Well, thank you for the opportunity to share a little bit of my work. And also, you can look for my some of the things that I shared on Twitter at Tavi Costa, and also at our website, Crescat.net, where we put out a lot of our letters, in-depth letters and research that you can look for and understand our views as we go.
Great. I'll put links to those in the description below. Tavi, really appreciate your time and hope to have you on again in the future.
My pleasure. Thanks.
If you enjoyed my interview with Tavi Costa, you won't want to miss my discussion with Andy Hosey from Finding Value Finance, where he revealed the 3 pillars he sees that signal the start of an epic commodities bull run, in addition to giving his thoughts on uranium, oil and gas, investing in shipping companies, and much more.